dear participants, very much welcome to this joint Preparers Roundtable, which is a joint feature by Business Europe, EFRAG, and the IASB. And the topic for today is to discuss the exposure draft issued earlier this year by the IASB, and also results from the field tests that have jointly been performed by EFRAG and the IASB. And we will receive input from representatives of companies, and where also you as an audience will be able to interact with us through polling questions and question and answer sessions. So it's a great pleasure for me to welcome you all here. My name is Claes Norberg. I'm an EFRAG board member, and I'm also the chair of the Business Europe Sounding Board. If we look briefly at the agenda, we have this setup that, first of all, Nick Anderson, who's an IASB member, and Ida Vatreniak, IASB technical staff, will explain the objective of the joint field test that has been performed with EFRAG. And we're also Catherine Schone, who is the EFRAG project director, will explain the EFRAG's outreach activities and the workshops established with the companies. After that, we will move into a discussion on the application of the IASB proposals and experience from the field test. And for each topic, we will have Nick and Ida outline the main relevant parts of the IASB proposals included in the exposure draft. And Felipe Camilo Alves, who is an EFRAG senior technical manager, will outline the key themes identified in the field tests. After that, we will move to a discussion with representatives of companies, including those that did participate in the field test, to provide their experience applying the exposure draft proposal on selected topics. I will seek input also from the panel and from also other preparers that you might want to join with through the Q&A and polling questions. And to my help to manage this, I also have Christoph Scharte, who's an EFRAG TAG member and head of the accounting and group accounting officer of Vonovia SE, and he will help to moderate the polling questions and questions from the audience. We will do this session divided into 4 topics. And the first one will be classification of income expenses. The second one, integral and non-integral associates and joint ventures. The third topic will be analysis by expenses by function and nature. The fifth will be management performance measures, disclosures, and unusual items. And in order to seek input from the companies, we have also distinguished group that has decided to join here. And I want to introduce those panelists. First of all, it's Eva Kalk, who is a manager of financial instruments and liabilities and accounting policy at Siemens. It's Andre Besson, he's the head of financial reporting guidelines at Nestlé. It's Susanne Beck, who's a finance expert of corporate financial reporting at SAP. It's Wanda Maruszewska, who's with Welding Alloys Polska, and also Ezio Santroni, who's working with the INE Accounting Principles and Regulations Competence Center. So that will be much appreciated with this input. With that, I would also first like to check that you have received through your invitation and access to the Slido, where you can first of all answer our polling questions, and secondly, you can also raise questions during the Q&A session that we will then pick up during the run of the webinar. So let's first kick off to see if I can get polling question number 1 on the screen. And here we want to see who you are and who are participating today. So please go ahead and answer polling question number 1. Thank you very much. And here we can have a first result. We see that There is a majority here with corporate preparer background, also financial institutions, accountancy profession, and academics. So with this webinar mainly aimed at preparers, it seems to be a relevant audience, but also academia and accountancy professions are, of course, much welcome to participate. Thank you very much. And let's move directly into our program here. And I would like to give the floor and the word first to Nick and Aida from the IASB to explain the objective of the joint field test, and thereafter Katrina will also explain the EFRAG outreach activities. So, Nick and Aida, the floor is yours.
Thank you, Klaus, and good morning, everyone. If we could go to slide 6, please. The board's project on primary financial statements is in direct response to requests from the users of financial statements for improvements in performance reporting. Every substantial proposal included in the exposure draft, with one exception, reflect long-standing requests from investors. We're pleased with the initial feedback that we've received on the proposals, but clearly it's important for the board to weigh up both costs and benefits. We're still very much in listening mode, and we're grateful to all of you for your participation today. The next slide summarizes the main proposals, which fall into 3 areas. These are improving the structure and content of the statement of financial performance, ensuring that investors receive sufficiently granular information in the financial statements, and finally ensuring those key non-GAAP measures performance are disclosed in both a transparent and disciplined way. Above and beyond this, there are a number of proposals included in the exposure draft, which are really consequential changes impacting the cash flow statement. And with that, I will pass over to Aida, who will briefly outline the purpose of the fieldwork.
Thank you very much, Nick, and good morning, everyone. Thank you for joining us today. I'm just going to talk briefly to slide 8 about the role of the fieldwork, which is a very important role in the IASB and EFRAG's due process. And really the purpose of it is to help the IASB, help the board get a better understanding of how the proposals would affect those that apply and use IFRS standards. And with that, I just want to say we are really grateful to many companies who have volunteered to go through this exercise. In this project, companies across the world, and some of whom are taking their time to join us today. And in this exercise, they've done a number of things. So they've looked at their how the proposals would apply to their financial statements. So what would their financial statements look like applying the proposals, looking at what system and process changes would be needed to implement the proposals, and finally looking at the clarity of the guidance of the drafting of the requirements and any improvements needed there. So as you can see, it's a quite different process from our general comment letter and outreach process, where the focus is on the views on the proposals. Here, the focus is really on practical application challenges, on practical effects, and it's really complementing the comment letter and the general outreach. And with that, I think just maybe remind us on the next slide where we are. We are quite towards the end of our consultation on this project. So the consultation period has been extended due to pandemic, and it ends at the end of this month. And the final proposals are expected to replace IS1 and form a new IFRS standards. And here we have links to some of materials for those of you who haven't had the opportunity to read them yet. So I think with this introduction, we are ready to start to hand over to Catherine. Is that right? To give a bit of overview?
Okay.
Yes. Sorry, one moment to unmute. The EFRAG has published a draft comment letter on primary financial statements on the exposure draft in February 2020, and we try to get input from many stakeholders to have the good result for the final comment letter. So to stimulate the discussion, we have organized several outreach events with national standard setters, with users, we have been contacting several organizations like the European Central Bank or EBA and as well industrial organizations. We have contacted Accountancy Europe. So we try to have really a wide discussion because the standard is really important. Secondly, we have tried to get input during field testing, especially on the application of the new expected standard. And we really appreciate the input from the companies that were participating. But we became aware that because of the current pandemic situation, several companies could not participate in these field tests. And so we tried to organize this event to bring together companies that were able to participate in field testing with those that were not able to participate in field testing. And so we have this discussion. So these companies, some of the companies that you can see here in the discussion as panel members have been participating in the field testing and some others not. So we are hoping to get more input, and we hope to have a good discussion in today's event, and especially because we can get input through Q&A from the audience.
Thank you very much, Katrine, for this intro.
Slide 11, please. That's it. So operating profit and EBIT subtotals are commonly used by IFRS preparers today. And although these subtotals share the same label, the meaning is often very different from one company to the next. We looked at a sample of 100 international companies. We found 63 of those presented an operating profit or EBIT subtotal, but within that there were at least 9 different variations in how those metrics were defined. So the board is proposing to introduce a more comparable structure in the statement of profit or loss with defined subtotals and categories in between those subtotals. The board proposes 3 subtotals and 4 categories in the statement of profit or loss, and these can be seen on the next slide. Here we can see the subtotals highlighted. This example here is meant to show how these proposals work for most companies, and we'll come and talk about banks and insurers in a minute. So you can see at the top of the statement, we have an operating category and an operating profit subtotal. And as I highlighted a moment ago, operating profit is a very commonly used subtotal with many definitions. So the board thinks that it's important to provide a definition, and this will improve financial performance reporting. Defining operating, however, can be challenging, and the board has decided to define the subtotal as residual. So anything that doesn't fit into any of the other categories that you see there on the right-hand side goes into operating by default. The third subtotal above the financing category is profit before financing. And this subtotal is intended to help investors analyze a company's performance independently of how it's financed. Items that come below this subtotal mostly relate to interest expense on financing liabilities, but there could also be the unwinding of the discount on liabilities such as pension liabilities and other provisions, and also income expenses for cash and cash equivalent, although it's not shown in this example, would also be in this section. Then above the financing category, we have the investing category. The aim of this category is to capture income and expenses from investments that generate a return independently for the company's other assets, and that users will often value separately from the entity's main business. We expect here to see things like returns on investments in financial instruments, such as dividends on holdings of equities or investment properties, for instance. So that covers off the three main categories, leaving the integral category and subtotal in the middle of the financial statements, called operating profit and income and expenses from integral associates and joint ventures. Now, we have a separate section to discuss the treatment of equity accounted associates and joint ventures, so we'll return to this in our next section. What I would say in terms of what we've heard from investors is that operating profit is a key subtotal for them, and it is of absolute importance that it is free of any contribution from equity accounted associates and joint ventures. We could now move to the next slide and consider financial institutions. So the model I've just described is the general model, and it's clear that that general model would not work for all companies. Think about a bank, for instance. If the bank applied the general model, they'd put interest expense in the financing category rather than the operating category. And that would mean it wouldn't really be possible to demonstrate or show net interest income as a subtotal, which most banks currently do today. Clearly, that wouldn't make sense. So in response, the board has identified some principles that describe, in particular circumstances, which companies, such as banks, would move items up from the investing and financing categories into operatings if such items related to the entity's main business activities. So this example shows a bank that provides loans to customers and invests in financial assets as a main business activity. So we expect them, as it's shown here, to move their interest expense into operating profit, as well as their investment and trading income. The principle would also apply to insurers, for instance, particularly around their investments, and also to other companies that provide financing to customers. The construct of main business activities was introduced by the board solely to ensure that there was a realistic portrayal of performance for such entities. Some entities would be exempt from presenting a profit before tax, before financing touch subtotal under this structure. And so with that, that's my outline. I'll pass over to Philippe.
Philippe, can you hear us?
Looks as though his name has dropped out from the call.
Yes, I think we have lost him for the moment. We'll see if we can get him.
Okay, then I will try to jump in and say something. So the classification of income and expense, what we were experiencing is that the participants rearranged the presentation of their income statement, and some of them experienced it as some kind of easygoing. For other participants, they say that they would appreciate more and clearer guidance. In particular, they appreciate more guidance on the definition of the operating category. It is very important to have a well-defined operating category that has as well impact on the classification of integral and non-integral joint ventures and associates, and therefore the definition was seen as a key definition in the new standard. It is, on the other hand, the definition of the investing category. The investing category is new, and some of the participants would appreciate a more and clearer definition, to have be able to classify the expenses and the generated income from the investments appropriately into this category. The classification of other items that were discussed were especially the foreign exchange differences and hedging instruments. The idea is that the foreign exchange difference is going to the same category as the expense or income to which it is related. Such foreign exchange differences are not easy to separate, and therefore it might be difficult to allocate them to the right category. And similar with hedging instruments. Hedging might be done on a net basis, and therefore it might be difficult to bring it to the right category. Interest from extended payment terms to customers, and that is something that would be appreciated if there is some guidance where to classify such contingent consideration, if it is operating. That's one of the questions that were discussed between the participants of the field test. Okay. I think that was one slide, and so I would hand over to the next.
So I think we can go to the slide 16. My apologies, I had connection problems, so I had to change the room. So there were different experience in terms of level of judgment involved. For some, no significant judgments were required. However, for others, the IASB proposals would involve a high degree of judgment on the reallocation of existing lines to the new categories. For example, on the allocation of income and expenses that arise from hedging instruments and foreign exchange differences. When referring to the costs, some of the participants also referred to the high costs related to the classification of gains and losses from hedging instruments and foreign exchange differences. This seems to be a topic that raises not only judgmental issues, but also high costs. And also, finally, the participants discuss materiality considerations when presenting the operating, investing, and financing categories. For example, they question whether a separate subtotal is needed if, for example, investments are immaterial. So I think these were the key topics that we discussed with the participants and the key feedback that we got.
Thank you very much for this introduction and presentations. So I now would like to move to the panel to invite comments on this. And first of all, I would like to give the word to Susanne Beck from SAP, which is one of the companies that participated in the field test. Please, Susanne.
Hello. So I would like to talk to the first question. Are the proposed requirements for classifying income and expenses clear and easy to implement? And which are the most challenging areas in that field? So the proposed requirements were generally clear to us, but the real allocation at SAP mainly concerned our foreign currency gains and losses and the financial income net. We had an issue with paragraph 56, so Mrs. Schöne just mentioned it. So there the ED says that FX differences shall be classified in the same category of a statement of profit and loss as the income and expenses from the item that gave rise to the FX differences. And so, so this reallocation of FX differences was really a topic for us. So because currently we show our foreign currency gains and losses basically in one line item below operating profit. And the benefit of this approach is that basically all FX gains and losses are in one place, enabling a separate analysis, commentary, and planning. And when we started our analysis for the field work, we found out that it is not easy for us to allocate the FX gains and losses to the operating, financing, and investing category. And this mainly derived from the fact that we often have mixed accounts for FX gains and losses. So that one component that was posted to such an account rather belongs to the operating category, and the other component belongs to the financing category. Or we had mixed accounts where where all components belonged to the financing category, but in the financing category, one component belonged to interest revenue from cash and cash equivalents, and the other to expensive financing activities. So this was quite some work to reassign our FX gains and losses. And if we assigned the FX gains and losses to the operating category, we then assigned it to a line item that is called other operating income expenses. So we decided not to further split it up in the operating category. And Philippe already mentioned materiality. So what we did for the field work was we included all line items proposed by the exposure draft, even though share of profit of non-integral associates and joint ventures, as well as interest revenue from cash and cash equivalents, are not material for us. So therefore, we would welcome a guidance where to assign line items they are not.
I think we are a small company, and comparing to all these corporates, we might provide quite different point of view because the size and the core business influenced our perception of the proposed changes in the preparation of financial statements. And the company I represent is a small company doing business in Poland, mainly in the service sector. Its basis for accounting is local Polish regulation, but due to the owner requirements, British capital, the company is obliged to prepare financial reports in accordance with IFRS. This is why our main concern in taking part in the field test was to get to know how difficult it will be to prepare for new standards and how different it will be when compared with existing local standards. So referring to the proposal requirements for classifying income and expenses between three categories, they first seemed very clear and revealing, as first of all, investing activity seems to be definitely separated from the operational activity. We like the structure, although we found that with no convergence to local standards, the differences will be very time-consuming. What I mean is to book them in a way to find them easily when switching from Polish local standards to IFRS. It was very helpful. It was also very helpful, in our opinion, to see a paragraph clearly stating that financing category includes income and expenses from cash and cash equivalents plus results in the form of expenses and incomes from financing activities. In our opinion, it is a good definition and a solution, especially in the part referring to cash and cash equivalents. On the other hand, we found no detailed explanation referring to lease, and unfortunately, our doubts were not resolved by the illustrative examples that include lease liabilities, I mean all amount of lease liabilities in the financing activities of the cash flows, while other paragraph, which is B36, describes only interest expenses referring to lease. We also kept gross profit line in the statement of profit and loss. Further, we found no need to define earnings before interest taxes, as well as earnings before interest taxes, depreciation and amortization, as in our opinion, profit before financing and income tax is very close to EBIT right now. We also had no doubts with new subtotal, which is called operating profit and loss. We think that it will enhance comparability. For us, it was not a new item, as we use it already exactly the same way as it is defined in the proposal described in the exposure draft. But when analyzing the comparability and transparency in the financial statements, we found that new subtotals will improve comparability for sure. On the other hand, new categories require revising, especially in the scope of statement of cash flow, in order to ensure consistency with the current project proposal. As far as we understood the IASB proposal, new classification valid for statement of profit and loss is not aligned with the statement of cash flow. From the perspective of our entity, we tried to align profit and loss with cash flow statement, as we found such a suggestion in the proposal. We considered most of foreign exchange gains and losses as operational category in both profit and loss, as well as in cash flow statement, to provide clear and consistent way. We would name this the most challenging area in the proposed primary financial statements exposure draft. In our opinion, the lack of cohesive approach would require a lot of work in order to provide detailed and relevant information, especially when IFRS uses the same words for a different scope of information. So answering one of the questions stated for today's webinar, yes, naming it differently would certainly help. And last issue, we found it not very clear from paragraph 118 that we shall use a retrospective approach to changes made, for example, within expenses classified between three categories. So it should be treated as change in the accounting policy, and additional third statement should be presented. It should be, we had to discuss it during the field test. It wasn't very obvious for us. That's all from my side. Thank you.
Thank you, Eva. And let's move to Ezio from ENI. Ezio, please.
Thank you, Claes. Good morning, everybody. I would like to express some thoughts about the most challenging areas that I identified during the field work. In particular, in recasting profit and loss accounts, I considered so challenging the exposure draft proposals regarding the classification of foreign exchange differences. As explained before by Katrin and the other participants, the exposure draft requires entities to classify foreign exchange differences in profit or loss in the same section of P&L account as the income and expenses that give rise to them. So, from a theoretical point of view, I think that this proposal will bring more clarity and more and will achieve a greater level of comparability across financial statements of different entities. But from an operational point of view, I'm concerned that the cost of tracing and tracking these foreign exchange differences could be high and higher than the benefits that the preparers and the users of financial statements may get from a distinct classification of foreign exchange differences to the various sections of P&L account. So I think that it could be useful if the IASB will provide for an explicit option that allows entities to classify all foreign exchange differences in a single item of the statement of profit or loss. Furthermore, I would like to share with you some issues, some potential classification mismatch that entities may experience in their P&L accounts due to the interaction of the classification of foreign exchange differences and the classification of some gains or losses arising from derivative financial instruments entered for risk management purpose. Let's think, for example, to foreign currency risk exposure arising from revenue and interest expenses that is managed for risk management purposes through a single derivative. We, applying the provisions, the requirements of the exposure draft, entities should classify foreign exchange differences from revenues in the operating section of P&L, the foreign exchange differences arising from foreign currency debt in the financing section of the P&L, while they have to classify all foreign exchange, the net gain or loss from derivative financial instruments in the investing section. This representation could be difficult to understand and could provide some classification mismatches on the face of the profit and loss account. And to conclude, I would like also to share with you some truths about the classification of gain or losses on non-hedging derivatives. If we look at the exposure draft proposals, we know that we have to classify that gain or losses in the investing sections, in the investing section of the P&L, unless those derivatives are entered in the course of the entity's main business activities. As expressed before, the IASB does not clearly define the meaning of the expression in the course of the entity's main business activity, and it could be useful if additional guidance or some further clarification could be produced in the context of the classification of gain or losses on non-hedging derivatives, in particular when they could be considered operating income and expenses.
Thank you very much, Ezio, for that. And with that, I would suggest that we go into a question and answer session directly. So I will now hand over to Christoph to get us on track with the question. We have a couple of questions from participants coming up.
Lars, we have also under this topic 1 2 polling questions. Should we activate also?
I think we move on directly to the Q&A, please, due to time.
Yeah. First question is Miriam from the International Committee from the Red Cross, a non-for-profit organization. And she is asking, as depreciation amortization related to investing activities was classification of investing considered? What explains the position in operating? And the question is, Aida, or would you answer the question, or is it more for your colleague?
Yes, I can't see Nick right now, so I'm quite happy to answer. So thank you, Miriam, for the question. And it's a quite interesting one, because I think, and it goes to the point Eva was talking about, lack of alignment between the statement of profit or loss and statement of cash flows. And that's obviously in the statement of cash flows, capital expenditures in the investing category, but in statement of profit or loss, it is in the depreciation is operating. But when we speak to investors, they give us a very clear, consistent message, is that when they analyze statement of profit or loss, depreciation belongs in the operating. It's part of operating result for them. It doesn't, belong anywhere else. And similarly, when they work with the statement of cash flows, capital expenditures, they would not consider part of operating cash flows, but they would analyze separately. So in terms of user needs, it's very clear that although there is no alignment, the users want it exactly as it has been proposed. So the board has not really considered that further, apart from asking whether users wanted alignment, and they clearly said no, not in this case.
Thank you very much. We have also 2 questions from Marietta Niemitz, and she's asking a question regarding the operating category being defined as a residual, and she's saying some users are pushing for a direct definition instead, but she doesn't see how this could work. So also a question to the panel and to the representatives from the IASB, Aida or Nick, if you could pick up this question.
I thought I heard Nick speaking early on, but I can't hear him. So unless he jumps in, I will maybe start with this and then maybe also ask our panelists on their views. But it's actually interesting because when the board was finalizing the exposure draft, the approach to defining operating category was seen as one of the more maybe controversial aspects of the proposal, to have this default approach. And as a reminder, it's a default. So the companies would look into what meets definitions of other categories, and anything that doesn't fall into that is operating. And the reason behind that was the board wanted to, it felt this would achieve more consistency, and also it would help, with the cost of application. But it was interesting in the feedback, we actually haven't heard much pushback, and probably somebody's going to contradict me. But generally, I think the feedback has been that it's quite reasonable as an approach, and it reduced the cost of application. It also helps users with consistency. So there have been maybe few calls on a kind of conceptual basis, because operating is so important. It feels like it deserves its own definition. But when we look at practical application and practical feedback, and I think in particular from investors generally, the message has been that this is quite a pragmatic approach that seems to be workable in practice. So yeah, it's perhaps a little bit less controversial than we expected, at least in some jurisdictions.
Thank you for that. I think we have time for another question.
Yeah, we have one further question from an undisclosed participant, and he's asking a question which was raised in recent times very often. And the question is, why does operating profit not align with operating segment per IFRS 8?
So it's Nick here. Can you hear me now?
Yes.
Great. So I can pick that one up. Well, I think one of the key drivers of this project is to ensure that we have a operating profit metric in the statement of financial performance that is comparable from one entity to another. Now, clearly within IFRS 8 segment reporting, that metric is a metric that's determined by entities, by management, in terms of how they choose to present their segment. So if we went down that route of using segment operating profit, we would have not met our objective of introducing comparability between entities. So we think both are important, and clearly they need to be, you need to be able to reconcile from one to the other. Yeah, that wouldn't have met what we're trying to achieve here.
Thank you very much.
Thank you. We have time for another question.
We have time for another question, and the undisclosed participant asks, cash flows. The exposure draft proposes to present the interest paid capitalized as part of the cost of an asset in financing. But why the financing rather than investing is the question. Is that understood, Nick, Aida? Can you see?
Question, Christoph, and I think really this is part of the this classification in IAS 7 and classification of in the categories is really not something that the board has done a comprehensive review of in terms of IAS 7. So there's been really just targeted changes to introduce consistency in where interest paid and received has been classified, and the overriding objective the board had there is that users wanted all of interest to be in one place. So where in some cases you might argue splitting that, like in this case, between the categories, the view was that overwhelmingly for general corporate interest is financing, and it should all therefore be in the financing. So it's a little bit different to the approach in the statement of profit or loss, where you might have perhaps interest split in some cases across different categories. But really just to emphasize, there hasn't been a detailed review of classification in the statement of cash flows as a part of this project.
Okay, thank you very much. With that, I think we round off topic 1, and I would like now to move on to topic 2, which is the issue of integral or non-integral associates and joint ventures, a significant issue. So with that, I would like to invite Nick and Philippe to give an introduction into this topic.
Thank you. So we could move on to I think we have a single slide from us on associates and joint ventures. That's it. Thank you. So what we know is that investors often value associates and joint ventures separately from a company's main business activities because they're different in nature. They're not fully controlled by the entity and they're accounted for using the equity method. So a key element of feedback, absolutely central element, is that investors don't want any share of profit or loss from associates and joint ventures included in operating profit. And partly, or I think largely, that's because there's nothing in revenue from associates and joint ventures, and to calculate a comparable margin, which is consistent over time and between entities, nor should there be any share of profit or loss from associates and joint ventures. But the board also heard from companies that as the nature of business changes, associates and joint ventures can be very important, if not integral, to their operations. And some would like to, and some do, and some would like to include these in operating profit. And examples we hear about are research and development sharing in the pharmaceutical industries, perhaps in some developing markets where it's not possible to fully own a subsidiary entity might work via joint venture. So the board felt they had somewhat conflicting messages here. And this led to the requirement for companies to distinguish between integral and non-integral associates and joint ventures. So the share of profit or loss of all associates and joint ventures is excluded from operating profit. The non-integral associates and joint ventures are presented in the investing category. But companies have a way to present their integral associates and joint ventures with slightly more prominence, and hence an additional subtotal was added and bringing that closer to the operating profit line, as we saw in that early example. And we also provided some suggestions or some examples of interdependency between the entity and associates that may make it an integral part of the business. So having integrated lines of business, perhaps sharing a brand name with an associate or joint venture, having a supplier or customer relationship with an associate or joint venture. Insofar, if you replace that entity, you might result in significant business disruption. So as I mentioned at the start, virtually all of our proposals were driven by long-standing requests from users of financial statements. This is the one exception to my mind. This was seeking to solve both the user's desire to have what I call a clean operating profit, clean of any contribution from associates and joint ventures, but also what we heard from companies who wish to reflect that some of their investments or some of their associates and joint ventures were closely related to their operating activities. Thank you.
Over to Philippe.
So I think we can go to slide 19. So this was one of the most debated topics where participants had many comments and expressed some concerns. As expected, the presentation of the subtotal and the line items related to the integral and non-integral was new for the participants. Nonetheless, some explained that a similar distinction was already being made for management purposes. I think in general, the information needed was available, subject to judgment, and no significant changes to the systems were required. Nonetheless, we got the comment that the classification of investments more in general is becoming complex, as you have subsidiaries, types of ventures, investment entities, joint arrangements, etc., etc. So if we go to slide 20 now. So when referring to the definition of integral and non-integral, participants express different experiences. So some consider that the classification of integral and non-integral was clear, all the required information was available, and did not imply significant judgment. However, others consider that it would be useful to have more guidance to ease implementation. Some thought that significant judgments may be required. Also, the definition of integral associate in joint ventures could be seen as narrow, as some of their associates in joint ventures would be classified as non-integral, while management saw them as integral, actually. I think one of the key points was that having clear guidance on the notion of the entity's main business activities. I think this is a key concept at the IASB ED that impacts a lot of different sections. So this is also consistent that having clear guidance on the entity's main business activities. And also we got some requests, or some participants mentioned that it would be helpful for the IASB to discuss how the proposals would apply to the separate financial statements. In practice, it raises some specific issues.
Thank you very much, Felipe. And with that, I would like to move to the panel, and I first invite Ezio to give your comments on this topic.
Thank you so much, Claes. I would like to start expressing my positive comments about the efforts made by the IASB to require for the classification of gains or losses from JVs and associates outside the operating profit subtotal. Having said that, I have to express some thoughts about the definition, the distinction between integral and non-integral JVs and associates. And I would ask for more illustrative examples and further guidance in order to avoid ambiguity and to reduce the level of judgment that entities should apply in order to perform such a distinction. In particular, it seems useful to clarify if the existence of a significant interdependency between the investor and the investee should be considered only from the investor perspective, or we should consider also the investee one. And it could be also useful to understand better what is the meaning of the expression having integrated in the lines of business, because it is not so clearly indicated inside the standard. And it could be useful for from the preparer perspective to have more indicators in helping the distinction between integral and non-integral JVs and associates. In particular, I think that the IASB could elaborate on the existence of significant financing transaction between the investor and the investee. or the fact that this distinction should be done considering through the management eyes. For example, the classification as integral or non-integral may be driven by the fact that the management considered the investment as a strategic one, so an investment entered with the purpose of establishing and maintaining long-term relationships with the investee, or if the management looks at the investment as an asset generating individual and largely independent returns, whether or not a supplier-customer relationships may exist with the investee. Another possible indicator that may be developed is represented by the fact that the results of joint venture and associate may be included in the calculation of specific management performance measure. If it is the case, we may consider that the investment is likely to be integral. If it is not the case, we may conclude that it is not integral. And to conclude, I would like also to express some thoughts about the interactions of these proposals with other IFRS standards, like IFRS 5 and IAS 28. Starting from the first point, I would like to express my opinion and to ask comments about the classification of an integral joint ventures. What happens if an integral joint ventures should be classified as a non-current asset held for sale under IFRS 5? Does this classification imply a changing in the consideration of the investment as integral or not? And if it is not the case, where we have to classify in the statement of financial performance any gains or losses arising from the measurement at fair value of the asset done consistently with the IFRS 5 provisions. And then I would like to express another doubt about the interaction with the IAS 28. In particular, we know that sometimes entities grant financing receivables to JVs and associates, which may be classified as long-term interest in accordance with the IAS 28. Thus, the interest income on such a loan should be considered an income from investing activity, or should it be considered strictly related to the whole performance of the JV and classified among income and expenses from integral JVs and associate? And the same would apply for the classification of an impairment loss on such a financing receivable classified as a long-term interest. So the question is, long income and expenses on long-term interest should be classified in the among the integral income and expenses if the investment is classified as integral JV or associate. And in order to perform our field work, we adopted some conventions, and it is useful to have a clarification on these topics. That's all from my side.
Thank you, Ezio. And let's move on to Eva Kalk from Siemens. Please, Eva.
Yes, good morning, everyone, and thank you also for giving me the opportunity to outline our thoughts on the proposal. And just to start with a general comment on the integral and non-integral discussion, we also think that the distinction requires significant judgment, and this might lead to a inconsistent interpretation in practice. And I will give you two examples on that in a minute. And we also expect high implementation costs because we have about 60 associates in joint ventures, we need to consider and to classify into these two categories. So we think that's very time consuming and also due to the involved judgment. Regarding your questions, what judgments are required? For example, the board gives the example that sharing a brand or a name would be a strong indicator for an integral business. So from our point of view as a diversified corporate, we think that sharing a brand name doesn't necessarily mean that the business is integral to the rest of the Siemens Group in our case. That's due because we predominantly grow our business internally or organically, meaning that we invest in technology or we invent something, build it up for about 20 years, for example, and then divest the technology or sell it to the market. And the new business shares our brand, the Siemens brand, because we think that might help to generate some revenue. So after the sale, we have the shared brand, but the remaining Siemens Group is done with that business and there's no business relation anymore. In this case, we think that we could argue once that it's integral because of the brand and maybe some remaining shared customer relationships, but we could also argue that because business-wise we are non-integral anymore. So because we're done with that business. And from our point of view, these kind of shared brands, but no business relationships, they shouldn't be shown in operating profit. And I think that's an example for how judgment is involved here. Another example is that imagine we have a material investment in a company that is involved in a technology or that has a technology that we are interested in and we consider relevant for our future. So at the moment, we don't have a business relationship at all. It's just a financial investment with the potential of a future R&D collaboration. And according to the provided guidance, as it is now, this would be considered a non-integral business since it appears to be just a financial investment. And the profit generated from this investment would be shown would be shown separate from operating profit, which doesn't convince us because it's future Siemens business. And the point here we're trying to make is that, or what we criticize here, is that it seems the underlying assumption of the board is that we generate some spare money and that we invest that spare money into the most promising companies with the highest profit. So, but that's in practice, that's never the case. So that's not true. We never invest in companies that are not related at all to our Siemens business. So we always invest in companies that provide for business opportunities or that have customer relationships we're interested in. And so we would also want to see the profits from these associates or joint ventures in operating profits because we consider it Siemens related. Regarding your questions, if more guidance would be helpful and more examples would be helpful to do the classification, I cannot give you a exact answer because generally we think that a principles-based ruling is more helpful because the list of examples would never be complete and you would always open up the discussion or you would always create more questions the more examples you give, as I've just showed you. Yes, so that's my point of view for the integral, non-integral businesses. Thank you.
Thank you, Eva. And I would like to move on to Besson from Nestlé.
Thank you, Claes. So I just want to endorse the points made by Eva and Ezio, particularly the calls for really clear principles. I think the board has started off with some principles there, but then maybe some further clarification would be needed because the paragraph 48, for example, calls upon the inclusion of should not include certain things in investing category if they're generated in the main course of business. And we just heard Eva describing how some preparers could view these kind of strategic investments. And this is a point I've heard both for financial assets under IFRS 9 and for this topic of integral JVs and associates, that the investment is always with a purpose, and therefore, especially if they're long-term or strategic investment, and therefore they would always be integral. So certain readings of paragraph 48 could lead to the classification of these things even directly in operating rather than adjacent to operating in the integral associates line. So I think that there could be some room for confusion there. One of the points that I heard Ezio bring up, which really resonated with me, was about the asset held for sale treatment and how to deal with the gain or loss on the disposal of integral associate, and to understand how that would be presented in the financial statements. And it comes then to a topic I'll raise in the next section. And then finally, coming back to Eva's point, really would endorse that this cycle of investment, control, and then disinvestment, I think could be better presented, because in some cases we have shared brands also for businesses that we've lost control over, we've divested, and while we might still have an equity interest in that investee, we don't see them as automatically integral. And then also in some cases, the shared brand will, the sharing of the brand will stop after a period of time, that there may be a time-limited license, either granted by the investor or granted by the investee in some cases, where they let us use the brand after the divestiture. And in such a case, if this is a very critical indicator, then we might have situations where an associate or joint venture will move from being integral to non-integral only on the basis of the shared brand, which we're not sure is really representing management's intent. If we've lost control, we might really expect that to be presented differently than maybe an onboarding exercise where we slowly start maybe with a financial investment and then progress progressively through a step acquisition to full control. For us, bringing in a bit more principle-based approach would help. Okay. So thank you.
Thank you very much for that, Andre. And with that, I would like to get a polling question on board, and I would like Robert to put on polling question number 4, which is a polling question that...
Yes, we have put it on, we put it live, and so far 21 participants have given us their answers. On the question, do you consider that the IASB proposals on splitting integral and non-integral associates and joint ventures can be easily and consistently implemented? And what we see is now 23 participants, that's the overwhelming majority of currently 83% do not think that it is easily to implement. 28. Yeah, we are now by 28 participants giving us their view. We are still with, now we have 36 participants.
this is interesting, I think, since there seems to be a significant issue here with this division. And I think that also moving over to the Q&A session while we're running this poll, I think that Aida, first of all, would like to raise a question with the panelists while we wait for other participants to join. So please, Aida, if you want to go first.
Thank you, Claes. And then it really follows on, I think, from the results of our polling, where Christoph noted that most respondents said that this is perhaps always going to be judgmental and lead to diversity in practice. So I just want to turn it back to panelists, and I appreciate really the suggestions on specific maybe indicators and also pulling it back to principles to help with guidance. But if given a choice, I mean, do you think there is a value in this split at all for your company? I heard some of you say, actually, everything you invest has some relation to your business. But then I know some of you perhaps have clear view that some bigger investments you have are clearly non-integral. So maybe just from your perspective, is there a value in identifying any investments in associates and JVs in your case as non-integral in your opinion? Or is that important information for your company, you think?
So,
Claes, maybe I'll jump in here. I'd say that we clearly have an associate at Nestlé where we don't consider it to be integral, where we would expect that because it's run completely separately, it's a listed company, and there's none of the other indicators that we talked about are mentioned, no sharing of brands and those types of things. In the past, we had a joint venture with them. So I don't know if that would be the kind of link that might maybe cloud the judgment. But in that case, so I think for that, significant associate, we would, I think, be able to apply the guidance fairly easily. Then we've got other associates which fall into this type of strategic investment. We might be interested in their technology in the future. And I think that's where the additional guidance would be useful to see, because right now there's no operational link whatsoever apart from a representation on a board where we follow the development and where we guide, giving our insight into the market, whether it's from a consumer perspective or maybe institutional customer perspective. Then we've got others where, as I described, they're much more operational, in some cases on an exit strategy, some on a entry strategy. And I think that's where the judgment would be difficult. If it becomes difficult to distinguish between the two, I think that already the clarification of an investing section, grouping all associates and joint ventures and certain types of financial investments into this section could be useful. And maybe then going to the next degree, which is the current proposal to split the associates and joint ventures between non-integral and integral, could be abandoned. But for me, there's already value in the current proposal of having the investing section presented separately.
Thank you for that. Now, if you go to the Q&A with the audience, Christoph, I have a couple of questions coming in.
We have got some questions, and I would like to start with a question from an undisclosed participant, and I would address it to the panelists. First of all, perhaps to Susanne. The question is, why split GVs in integral or non-integral, as there are also could be integral and non-integral subsidiaries, which also might be splitted? What is your view on this question? Susan still there? Or then I would perhaps move to Eva. Okay.
Yeah, so regarding non-integral and integral associates and joint ventures, at SAP we actually have just very few associates and joint arrangements, and they are not connected really to our operating business. Of course, that they are also IT companies, but it's a very small portion that we hold there, and of course no brand names are shared and things like that. And so we are actually, for us, this is not really a big topic because we consider all of our associates and joint arrangements as non-integral, and therefore we don't have these issues here like other companies.
Okay, I think that Nick also has a comment on this question. Please, Nick.
Yeah, thank you. So just to remind you that the genesis of this requirement. So we haven't heard from users wanting to split subsidiaries between integral and non-integral, nor have we heard from them to do so for associates and joint ventures. What we heard from preparers is that some of their associates and joint ventures are important to their operating activities, and so this proposal was designed to help preparers. And I think we have to listen very carefully to what we're hearing from preparers in that respect. Just one further thing, I've heard a few people mention that this has a bearing in terms of differentiating between integral and non-integral in terms of what goes into operating profit. And I think we just need to be clear on that the definition of operating profit includes no contribution from equity accounted associates and joint ventures. This is simply about differentiating between integral and non-integral. And I think we have to listen very carefully to what we hear from preparers on this question.
Nick, can I perhaps address the next question to you also? Yep. Because a participant is asking, when classifying investments as integral or non-integral, should we consider the underlying risk more than the relevant transaction with the investee? How has this been considered, this question?
From what I recall, and it's some time ago now, I believe there was a discussion of risk. I don't think it made the final set of proposals. I'd say these are indicators to try and provide some guidance and to help companies differentiate between the classes. I think I probably agree with I think what Susanne said, that probably more examples wouldn't help, and that we want to really leave this being principle based. But as I think I go back to that, if this really isn't helping entities describe their business in the way that we thought it would do, we have to listen to that very carefully.
And I have another question on this subject, which I would like to address to André Besson, if that's right. And the question is, how can we present subtotals without integral GVs if such GVs are insignificant but exist? André, what's your position on this?
Yeah, well, I think here we would have to weigh materiality. So if they're insignificant, at this point in time, I would probably, if I was in that position, having both integral and non-integral ones and none of them were significant, I would consider presenting them as a single line on the face of the statement of profit or loss, and then presenting the details in a note, even though that's not what would be required by the ED. But on the basis of materiality, I wouldn't necessarily want to clutter the face of the income statement with immaterial information. That would probably... then I think one of the questions is this operating profit after integral associates and JVs, which I think, coming back to Nick's point, is one of those communication lines that people might want to emphasize if they consider certain joint ventures and associates to be really important for their users. In that case, you might want to have the line on the income statement, even though the amount might not be material or might not be material every year. But I think it's certainly, in my case, I think there would be an argument to say that we would put it more in a note disclosure rather than present it on the face.
Yeah, finally, we have, I think, an interesting question from François. And the question is, if an entity considers integral and it is important, couldn't this be addressed through an MPM? So my take is, why should we use integral and non-integral subsidiaries rather than fixing it, so to say, in calculating management performance measures? Eva, Kalk, and Aida, what's your view on this? Perhaps Eva first?
Gustav, I'm not sure if I can answer that question, if I completely understand it. So maybe I pass on to Aida, if you can.
Thanks, Eva. No, I'm happy to jump in. I think it's. I think we get this question in relation to other proposals as well, in particular, maybe relationship between unusual and MPMs. And the question is, well, companies would, if something is important, would or would not reflect it in their MPMs, why not leave it to that? And the reason behind these requirements is these are the things that the board picked as those things that it thought investors would always like to know, regardless of what company does with respect to MPMs and does not. And this is why this is a separate requirement, and this is why unusual income and expense is a separate requirement. So it doesn't depend on management's view, but it always is something considered always to provide useful information to investors. But as Nick said, clearly this is an area where we're getting lots and lots of questions. So we need to consider very carefully in redeliberations.
Aida, and the last question I have here from an undisclosed participant asking if a GV is insignificant but exists, however necessary to show these subtotals, or can it be put?
So thank you, Christoph. And I like to agree with, I think what Andre said was quite pragmatic approach in that, if something is not material, then you're not really required to have a separate line item, and neither are you required to have this middle subtotal if your integral, associate and joint ventures are not material, and then you can simply put it in another line item. And, clearly judging by the number of questions on that's an area maybe that still needs to be clearer in the final standard.
Okay.
This was all of our Q&A questions on this topic. Live poll says 70% of the participants who voted, 46%, say that it is not easy consistently to implement. Claes.
Thank you very much for that. Something to take away from this polling session. Let's move to another significant topic, and that is the analysis of expenses by function and by nature. So over to Nick and Felipe to introduce this topic.
Ida, I believe, is going to pick up this one.
Indeed, thank you, Nick, thank you, Claes. So I think we have one slide on this. As Claes said, it's a very topic where we have lots of discussion about on classification of income and expenses, and specifically analysis of operating expenses by nature and function. So just a reminder, this is a part of the suite of proposals relating to disaggregation in the exposure draft, and it's really strengthening existing requirements in IS1. So it's not really meant to bring a new requirements, but as we will see from discussion, it's still causing quite a stir. So just as a reminder, even today, companies can analyze expenses using one of two methods: by nature, in other words, providing information about inputs used, or by function, which is when you allocate expenses to the activities, to the functions of the business. And this is not meant to change, but there is a few enhancements in the exposure draft. First of all, There's a clarification that this analysis has to be on the face. So currently there's an option which very few companies use, but some do, to present, to include this in the notes only. So either nature or function has to be on the face. The second clarification is that this is not a free choice. Entities need to select the method that is most useful in their circumstances, and there are some indicators to help entities decide that. And perhaps the most important part, and the one that has most controversy, is that there will be no mixing of the two methods. So, for example, companies could not have both cost of sales and depreciation on face. So I say there is no mixing of two methods with some caveat, because to the extent there is a specific line item required in minimum line items, then that would always be presented, even if it is not the same as the rest of the analysis of the expenses. So these are really the key kind of component of what is required on the face, and there is also complement to that in the notes, in that in addition to entities presenting whatever is the most useful method of analysis on the face, that is not mixed. If this most useful method is by function, in other words, if companies present cost of sales, R&D, and so on, then such entities should also present analysis of expenses by nature of inputs in the note to financial statements. And this is really to respond to user need for this information in all cases, because this is, they tell us, very helpful for them in forecasting future cash flows, whereas analysis on by function is useful for margin analysis. They can't forecast as well using function as they can using analysis by nature, which is why this would be requirement for all companies, and requirement to not just be selective, but have analysis of total operating expenses. So I'm not going to say much more about the feedback we'll be getting on this, but I'm sure we will hear now from Philip.
Philip, what have we heard so far?
So in terms of the field testing, so I would say that no significant changes or concerns from those presenting by nature. I think that the only concern was that if they would be required to change by nature to function because of the new guidance introduced by the IASB. But I think the most of the comments came from those that are currently presenting by function or using a mixed basis approach. For example, participants that presented their analysis of expenses by function, they wanted more guidance on the presentation by function on the line items. For example, there's no clear definition of items such as cost of sales or administrative expenses. And also they wanted more guidance on the use of the line item other expenses. Entities also consider that they would have to make significant judgments to allocate some specific items to the line items presented by function. For example, if they would have to allocate the restructuring expenses or goodwill impairment losses. And this point is also related to the point about the use of the line item other expenses. Can these restructuring expenses be included in other expenses, or can I try to allocate as most as I can and then put some remaining in other expenses? These were the kind of questions that we got. I think one of the points that, because there were significant concerns, were related to high costs on the disclosures of the total operating expenses by nature. So currently, the companies that are presenting by function, they mentioned that if they would have to follow the new requirements about the disclosures, they would be costly to apply, because the total amount of the disclosures would have to be actually the same as on the face of the financial statement. So, and again, this would raise another question about the use of other expenses when disclosing this information by nature. And finally, I think the point mentioned by Aida on the mixed presentation, whether it's allowed or not, I think that a number of participants wanted the IASB to clarify the link between paragraphs B46, which states that no mixed presentation and then the minimum line items, but also the B15 of the ED, which mentions actually these restructuring expenses, legal claims, etc. So I think this was also a point mentioned by a number of participants. And these are the main key issues.
Philippe, let's hear now from the panel, and I would like to invite Susanne first to give her views.
Mm-hmm. Yes, thank you. So I would also like to comment on that we would like to have the IASB to clarify how the paragraphs B15 and B46 are linked together. So because we currently disclose our P&L as a function of expense method, but we show our restructuring expenses as a separate line item in the P&L and provide then the information by functional areas in the note. In the exposure draft, in paragraph B46, it is that no mixture of function of expense method and nature of expense method, but showing restructuring expenses separately is actually a mixture of function and nature of expense method. 15 says that restructuring expenses can be presented separately. So in the field work, we decided to continue with our separate disclosure of restructuring expenses, but I would have some clarification here. And then I also would like to comment on the question how to classify FX gains and losses and where to allocate them depending by function. So as I mentioned before, we assign FX gains and losses if they belong to the operating category to the line item to us, but would be intended by the IASB that these FX gains and losses should be allocated to the functional areas in function of expense as a however, FX gains and losses result from the FX valuation of assets and liabilities, but we do not assign functional areas. Functional areas for the FX gains and losses come from if they cannot take from the liability. So I talked to our IT colleagues, and assigning functional areas to assets and liabilities is technically possible, but it would be a bigger project to change our system for that. So for the field work, we were not able to find the FX gains of functional area. And so that's why we hope that the IASB also allows to assign the operating FX gains and losses to another position in Thank you.
Let's go to Andre.
Okay. Thanks, Claes. Thanks, Susanne. On the question of a mixed presentation, for me, for restructuring, at least this doesn't arise. Because in my view, the fundamental question that's being asked in paragraph 70, it's where it defines the function of an expense method, is why did you incur those costs? So why did the preparer, why did the company incur those costs? And for me, the answer to that question for restructuring is fundamentally different than the cost of goods sold or the cost of distribution. So therefore, in my view, not only can we, but I think in many cases we should present restructuring costs separately. We had one discussion with a user who said that they were observing a company, and the company showed quite consistent research and development expenses in a presentation by function. And over years, they realized that actually these research and development costs included significant restructuring expenses. And it meant that the information content of that line item, I think, was quite low, because the user couldn't tell that there were termination benefits or impairment costs that were being written off through the research and development line as compared to more productive research and development activities. So for us, the costs that have an exit purpose, that are linked to the shutdown of an activity, to the substantial change in which a business is run, should be presented differently than those which are linked to the running of the distribution function or the manufacturing function. The decision is made by different people. For example, the decision to restructure an organization is made at a much higher level than the day-to-day operating activities in the production or distribution function or the administration section. And then the touch point on the question of other costs, and if we don't present others on the face of the profit and loss account, then we will end up with them thrown into administration, which will become other by default. So for me, where the guidance should be enhanced, I like what's in paragraph 70, but I think it should be further enhanced. And I will make a proposal in the comment letter to make a principle-based distinction between the nature of an expense, which is what expense have you incurred, and the function of an expense, which is why you have incurred it. I think this is a useful principle on which to make the distinction. And then from that principle, I think you can apply that, well, restructuring involves different natures, so it can't be a nature of its own right. It involves termination benefits, restructuring costs, impairment costs, and onerous contracts, for example. So with 3 different types of nature, it can't be a nature. So for me, it's much clearer to present this as a function. Then you could say, well, should it be a function presented grouped with other functions, or is it a function in its own right? And I think this comes down a bit to materiality. Another one where I think the mixed presentation prohibition could become confusing. It's the gains and losses on disposal of businesses, because it's not entirely clear to me where these would be presented. I heard somebody even ask if it should be presented in the investing section, but I think this was answered in the ED. But I think it could be something that could be clarified. And then goodwill impairment is another one where my view is that it's not entirely clear where this would be presented. And I think this was also raised in the field work, the field test. And I think some clarification there. If the board thinks that it's important to present goodwill separately on the statement of financial position, then it could be also maybe an exception to present goodwill impairment separately if material for the company. Obviously, if it's not material, it should be aggregated with other items. So for me, the application issues and maybe even the examples that are given, I think more complex examples could give rise to easier application, because I think that right now, even enforcers and auditors are a bit forced to take a very narrow view, because the examples in the standard take a very traditional view of functions. And if the examples were a bit more reflective of some of these points, goodwill impairment, restructuring, and gains and losses on disposals, it would allow both the regulators, auditors, and preparers to take a more flexible view and really focus on the information content. As I said, this user who felt that they had been misled by the company who had mixed restructuring costs with R&D costs, I think was a clear example. And I was a bit surprised when they said that, because we would not have presented it that way. But I certainly understood why they would have felt disappointed that that was presented that way. So yeah, Claes, maybe I hand it back.
Yeah, thank you, Andre. And let's go to Eva Kalk.
Yes, thanks. Yeah, we fully support the view of, or as outlined by Susanne and Andre. So yeah, we also think that all of a sudden there's a mixed approach. Yes, you have to choose one method for the financial statement, but then do a complete analysis in the notes of the operating expenses just leads to confusion. And regarding the system changes, we just think there's way much more work behind that additional analysis by nature than the board actually thinks there is. And we would like to ask the board to take a perspective of a globally operating company with a few hundred subsidiaries to answer that question. So the system changes regarding the ERP system that needs to be adapted to be able to produce both the by function and the by nature method. And yes, please consider that on a global scale. And we think that will definitely result in a worldwide IT project for us, which will certainly take more than a year to be finished. So yeah, we are really disappointed that the IASB doesn't take that into consideration. And also the consolidation software needs to be adapted for the elimination of the intercompany transactions. And again, please consider that on a global scale for a few hundred subsidiaries, which in case of Siemens, all run on a by function method. And regarding the reliefs that could be considered, we are not thinking in reliefs. We just recommend to maintain the principle of two methods, of two equally considered methods as it is now, and with the possibility of management to choose between the two methods depending on the specifiers of each entity and, of course, on the usefulness of information provided to the user of the financial statements. And just one thing I wanted to add here is that the reasoning of the board to make it more easier for investors to forecast cash flows based on operating expenses presented by nature is an argument we cannot follow because, or in our point of view, this doesn't lead to a good result if you take the operating expenses on a consolidated level. And I don't think that any investor is interested in consolidated or group numbers in order to forecast cash flows. So they would always have a look at on the segment level or business level. And therefore, we just have the difficulty to see the benefit of the additional disclosure here by nature, and we just see the big expenses and the big and the costs for changing the IT systems. Thank you.
Thank you, Eva. And with that, I would like to move to Eva Wanda Maruszewska.
Yes, I'm here. And in order to comment on this topic, I would like to start with saying that we have already presented expenses by nature and by function. So the idea is not new to us. This is why we welcome the proposal, and we think it provides more information about expenses. Different view on the classification of expenses, in our opinion, will improve comparability of financial statements. From our experience, it seems that costs by nature are better for forecasting future cash flows, and I can hear that this is opposite view to what Eva Kalk just said. As this is, we think that as the main goal of the general purpose financial statements is a comparability, we think that the proposal should be welcomed also by investors. What we did not do in the past, although presenting by nature and by function in the financial statement, is the presentation of the expenses by function and then disclosure by nature per each line or per couple of lines summarized together. Unfortunately, mainly due to differences in local standards in this area, plus due to time-consuming calculations required, we did not decide to provide disclosures in this way. But we think that matrix presentation would be very informative, not only for readers, but also for the internal users from the entity. But of course, it would be very costly. Our approach to present each line is in line what Andre just said. By nature means what kind of expense you occurred, and by function why you had this expense. And this is why we wanted to correspond. Nonetheless, we believe that any more precise presentation of expenses is desirable from the point of view of comparability and transparency. Further, another issue is that, in my opinion, it's a pity that I found no requirement to provide expenses by function when profit and loss statement is built on the classification by nature. This is the opposite situation, and it seems there is no symmetry in the disclosure requirements. This thought came to me because in Poland, a lot of entities disclose expenses by nature, and for the managerial reasons they also use by function classification, but in the books only, so there is no problem to present it in the additional notes. Going to the next, the third issue is, and referring to our experience in the field test, I must say that we welcomed freedom with the classification of the cost by nature. It allows the company to use their own classification instead of the one that is most popular, and we refer to the local one that is built out of 8 lines. We are obliged to use 8 lines, and in the field test, we decided to provide 17 categories that were based on materiality and specificity of our company. And we think that by this way, we provided better, deeper information about the entity. And what is more important for us is that other expenses item amounted only 5% of operating profit or loss, while before it was sometimes it was even more than 40%. But on the other hand, we were wondering how comparability will be assessed, but we believe that as the time passes, the entities will work out similar categories within the same sectors, and the diversity will not be the issue. In sum, we welcome the idea to let it free in the scope of categorization of cost by nature. And the last thing I want to mention is the impairment that was already mentioned, I think, by Aida. As far as we understand from the proposal, the impairment might be disclosed among each out of 3 segments: in operational, in financing, and the investment activities. At present, in our company, impairment of raw manufacturing materials or merchandises was presented in the category of other operational expenses, that is below gross profit. In the field test, we decided to include some part of impairment to the expenses by nature and label a separate category impairment. And, well, that was not the last one. The last one is the foreign exchange. What I made in my notes is foreign exchange gains and losses, as we have a lot of them in our company. And as we have read in the proposal that an entity shall classify foreign exchange differences in the same category of the statement of profit and loss as the incomes and expenses from these items, we are now aware that new standard would require to split accounts at least into 2 categories in case of our entity, into foreign exchange gains and losses referring to cash, and it will be disclosed among financing category, and into foreign exchange gain and losses referring to receivables and liabilities that will be disclosed as operational segment. So, in our opinion, impairment treatment and presentation will be a big change. And what's more important, it cannot be automated within the system. What I mean is that we cannot predict all possible cases that will occur in the future, so it will not be automated in 100%, and that might be a big challenge for the future. Thank you.
Thank you, Eva. interesting exchange of view among the panel members here. So I would like now to move to polling question number 5 to see also how the audience react to this important issue. So please, can we get that on board? Thank you very much.
Polling question number 5 is open, and we would like to understand what it means to your systems and procedures. And I would like to invite you again to participate in our polling question. What we currently see is that out of 25 participants, 36% say that the information which is required is currently not in the system. And now, as participants are joining, the votes are changing. And in addition, if you have any contributions to our Q&A session, feel free to drop the questions in our Slido system. So, Claes, we have now 39 participants voting on question 5, and it isn't moving anymore. So, if you would like to comment, or somebody would like to comment on the results of the poll.
I think Nick want to make a comment on the polling. Yep.
Yeah, no, thank you, Klaus. So interesting results. Interesting that over a third actually are presenting operating expenses by nature in their financial statements. And then another significant proportion who say the information is available, but obviously a significant cost. And I think that's what we've heard generally, that there are systems issues here. But I would just clarify that probably the call for this information, for the by nature information, comes very strongly from investors and from analysts, particularly in Europe. This is where we hear it most strongly, and it is because it helps them more intuitively focus cash flows. They do want to focus cash flows at the group level, perhaps not for credit or credit investors, but certainly that's what equity investors do. What they would really like, of course, is the matrix, to have every operating expense by function broken down by nature. But the board already shied away from that as being prohibitively expensive. There's still some desires for that, and clearly some by nature numbers such as depreciation, amortization, and employee expenses are already required for all preparers by function today. Eva asked a question about why no symmetry to the requirements. By and large, it's simply we didn't have the demand. We weren't hearing from users where companies presented by nature that they wanted to see those numbers by function. And indeed, that would then be requiring entities to make allocations into functions and expenses. So in summary, I'm not surprised by the results of the polling questions. Apart from so many entities presenting by nature, I thought that might have been a little lower. But it's broadly consistent with what we've heard before.
Nick, still some time for some questions from the audience. If you'd like to raise that through the Slido.
I have one question, perhaps to Aida or Nick. Can you please clarify the first implementation method of the standard? Will it be requested to use a retrospective method, Nick, Aida?
Yes, so it is a retrospective application. I think generally it's worth clarifying that the proposals in this project do not affect recognition and measurement of assets, liabilities, income, expenses. It is really all about presentation and disclosure. So from that perspective, I think the board thought that it would perhaps not be as difficult to achieve retrospective application as in some cases, but without use of hindsight, which would come into play into some of the proposals.
Okay. If there are no further questions from the audience, I would hand back to Claes.
Thank you. Thank you very much, Christoph. And with that, I would like to move to the last topic for today, which is also a very significant topic. That's basically two subparts here. It's about, first of all, the reporting of the management performance measures, disclosures, and also the proposal to have a new requirements about reporting of unusual items. So those are grouped into one topic here, but basically there are two different issues. So with that, I would like to first hand over to Nick and Ada and Philippa to give an introduction.
Thank you so much, Claes. And as you say, one topic, but actually, several topics here and lots of discussion, because these things are quite new for IFRS standards, or new old in the case of unusual. So maybe looking at the non-GAAP measures, the slide here really illustrates the need or what prompted the IASB to work on this. So as everyone knows, I'm sure many companies today choose to communicate using non-GAAP numbers. They allow companies to tell their story in an entity-specific way, and we looked at sample of 100 companies, as Nick referred to earlier, in the board's research in preparation for this exposure draft, and we found over 90% of those included some kind of a non-GAAP measure, and I think this is consistent with findings in other studies. And here it's also CFA Institute has done a survey of its own members a few years ago on the use of non-GAAP measures, and it just here illustrates that vast majority of them use these measures, and lots of them use them very, very often. So they find them useful, but they don't get all they need from them. And I think this comes across a little bit from this extract from ESMA's report on use of APMs that they issued at the end of the last year, and maybe in the user's words saying that there is information about them, but information can be sometimes hard to find. It's not all in one place. It's not necessarily consistent. And as ESMA found, there's some shortage in quality of information that is being provided. So really what the IASB is doing here is bringing a subset of these non-GAAP measures that complements its proposals on the subtotals and the statement of profit or loss into the financial statements, and the purpose is to increase transparency and to increase discipline with which this information is provided to investors. And I think we have on next slide a brief overview of what these proposals entail. I'm not planning to go through detail of definitions now. I'm sure everyone today has looked at it, but it's the focus here is that there will be a single note disclosure of these measures that meet definition of management performance measures, and along with disclosure of these measures, there would be a number of disclosures, and it's important to emphasize that these are not that different from what is required today by many regulators, but there's few exceptions. I think specifically disclosure of tax and NCI, which I will illustrate briefly on the next slide, is a new disclosure for most companies. In our sample analysis, we have found few that already provide this, but most do not. And also what is important important to highlight here in response to question we often hear, well, our regulator already requires pretty much all of this, why duplicate? This would apply across all the jurisdictions, across all companies that apply IFRS standards, regardless of what the regulator does or does not require. So it will give users this consistency of information they'll be getting around these measures, regardless of company's jurisdiction. And important point, very important factor for investors, they tell us, is bringing these measures in the scope of audit, just giving them more comfort level about this information and how it's being provided. So on next slide, we have just a little bit of illustration of what this no, actually we don't. So what we have here is just a highlight of what I was mentioning earlier, is the measures are a subset of non-GAAP measures. So not all non-GAAP measures will be brought into the scope of management performance measures applying these proposals, but the scope is really limited to the measures that complement the subtotals in the statement of profit or loss, and they are not IFRS defined measures, because if it is IFRS defined unspecified, then there's no benefit of these additional disclosures because it's already understood what the measure is. So what we have is measures in this green box, so income and expense subtotals. This does leave out, I don't think many are surprised that non-financial measures are not here in this box, but there are some measures which are widely used, such as free cash flow, such as some ratios that are out of the scope of these proposals. And I just want to highlight that this is not because the board thought that these measures are not useful, but it was really for the MPM purpose, was complementing what is in the statement of profit or loss and the subtotals there, and measures such as free cash flow doesn't really do that easily, and similarly ratio does something different. So that was really the only reason that they are not included in the scope. And then the slide I was talking about, which is the next slide, which just gives a bit of illustrations, very simplistic illustration of what this reconciliation could look like. And then adjacent, we have information around tax and NCI that will be provided for each individual adjustments between IFRS specified subtotal and the management performance measure, to enable investors to calculate their own adjusted earnings per share measure if many investors, equity investors, do this analysis. So that is quite important to them. So with that, I think I will stop here on the management performance measures and just talk briefly around proposal for requirement to a disclosure of unusual income and expenses. So I think we have a next slide on that, and this is really, it's in response to user demand for information about income and expenses that help them forecast future cash flows that have more predictive value versus less predictive value. So this recurrence of earnings is what is important to investors, and this has been recognized. So many companies today would describe items in the income statement or in the notes as unusual or non-recurring. But again, the problem with doing that today is because this is not defined. Users don't know what definitions companies have necessarily used to arrive at this. They don't know if they've been defined consistently. They don't know between different companies, between periods. So it's very hard for them to use that information with any level of comfort and to what that provides. And yet it's important for their analysis. So this proposal is really looking to address that, to require all companies to separately identify income and expenses that have limited predictive value. On the slide here, we have a more detailed definition of what that actually means. So it's a very forward-looking view of identifying income and expenses that are not expected to recur in several future annual reporting periods. So this is really in response to, we often, I'm sure we will hear in discussion, things like restructuring. Users tell us they often see described as non-recurring, but yet they see them for every year for over 20 years, whereas genuinely in some some companies' cases, it might be unusual, but in others, it may not. So it's really not about identifying specific type of income and expenses, but it is in the context of the company, what in this company is not expected to recur in future reporting periods. And I think with that, just a bit of note to the disclosure requirements. So this information would be included in the notes. It wouldn't be on the face generally. We talked about nature function just a moment ago, and the expenses would be analyzed by nature or function. That usually doesn't lend itself to separately identifying unusual items on face. So this would be no disclosure, but in this no disclosure, companies would have to show what line item on face does this unusual income or expense relate to, so that investors can have this link. And you know, it's a good, we discuss MPMs and unusual together. There is clearly a relationship there, in that many companies in arriving at their management performance measures would adjust for unusual income and expenses. But the board thought it was important still to have this as a separate requirement to ensure that companies provide disclosure of all unusual income and expenses, not necessarily only those that they adjust for, they choose to adjust for in management performance measures. And secondly, that this information is provided by all companies, because although vast majority of companies use management performance measures, we have companies that do not, and these proposals in the exposure draft do not compel them to have management performance measures, but yet information about unusual income and expenses is useful regardless. So with that, I think it's time to hand over to Philip to talk us through some of the feedback we've been getting on these two sets of proposals.
Yes, Philip, floor is yours.
Thank you very much. And we can go to slide 30. So in general, participants did not have significant issues in identifying the MPMs. I think they easily identified them in the different communication tools. I think, but however, there were some requests for the IASB on the definition of MPMs. I think the first one is clarifying the meaning of public communication, because it seemed too wide and the companies were not sure, for example, a Twitter or something like that could be considered as public communication. Another point was that the definition of MPMs may be too narrow. It was interesting to see that some companies disclosed alternative performance measures that actually did not meet the definition of MPM, and they disclosed these APMs together with the MPMs. And they explained that they wanted to present both the MPMs and other alternative performance measures, because that's the only way of providing the complete picture of the entity's performance. Meaning that if they would only provide, let's say, 3 or 4 MPMs that they have identified, they were a bit concerned that they would provide an incomplete picture of the entity's performance. That's why in some cases we saw that MPMs were presented together with APMs. There were also questions, more questions about how to make the disclosures on MPMs in practice. So, for example, the first question, and it's related to the previous point, is whether the MPMs can actually be presented together with other non-GAAP measures. Is this allowed, or is there any restrictions? And including non-GAAP measures related to the balance sheet. Another point, a lot of questions are around the interaction of the MPMs with other regulatory requirements, such as the ESMA guidelines, local management report requirements, and even for financial institutions, the regulations about their specific business. And they also mentioned that this interaction was important because they had different scope, meaning that they would have to present different information in different places with different scope, and this could be confusing. In terms of the information, in general, the information was readily available, except for the effects of the income tax and non-controlling interest. This was one of the key concerns that participants raised. They noted that the computation of income tax can be complex, particularly when there are different tax jurisdictions and when they are using constant currency performance measures. So this was one of the main concerns that we have received. If we go to the following slide on unusual items. So some already disclose unusual items in the notes, as Aida mentioned, but the definition, the new definition that the IASB provides may lead to changes. We also received very specific comments on the definition of the unusual items. Sometimes it was considered too narrow. It would exclude some of restructuring expenses that they thought it would take 2 years, for example, and they thought that they should be considered as an unusual item. And also some participants thought it wasn't clear whether the definition of unusual income and expenses requires both criteria, the type and the amount, whether they have to be met together. In terms of the judgment, we also received specific comments about the applicability of the IASB proposals because of the level of judgment involved, particularly the term several future annual reporting periods and predictive value. Participants thought that these terms would involve significant judgment. And participants also mentioned about the judgment that they would have to apply when using this concept at individual level of the entities, as subsidiaries, and also at the group, and whether there should be some kind of consistency, or it would raise a lot of questions when applying to the different elements or to the group and also to the subsidiaries, etc. I think these are the main points raised by participants.
So this, those topics raises a number of application issues. With that, I would like to move to the panel and first invite Wanda Maruszewska to provide her.
Yes. So our comments are as follows. So to start with the definition of measurement performance measures, this definition was clear to us, and the requirement to disclose it in a single note was also welcomed by us. We were surprised that totals and subtotals of profit and loss statement and those lines that were used for MPMs are not to be disclosed in the single additional note. I understand the arguments that Aida said, and they are very clear, but from our perspective, it was a partial presentation of MPMs, and we thought that selected indicators were detached from the rest and their interpretation without linking them to the other chosen by the company, chosen by the owners, that the interpretation was incomplete. So the exclusion of IFRS specified measures, in our opinion, means that MPMs are not well addressed in the financial statement. And well, maybe that's our opinion because, as I said at the beginning, we're a small company and we do not use expanded system of MPMs for the assessment of the management. So this is why in our note we decided to provide a full list of MPMs in order to, as it is in the proposal, faithfully represent different aspects of financial performing. We were wondering whether there is a room for predefined MPMs for certain sectors, but we thought that time will show that maybe we will have similar MPMs for similar sectors. We were also looking for a suggestion whether to present non-financial measures if calculated by the company for MPM's reasons. Because on one hand, the proposal suggests to faithfully provide information about different aspects of performance. So we thought that financial performance is inherently connected with non-financial measures. But we found that there is no reason, there is no requirement to present non-financial measures, but still because the most important for us was to present the whole set of MPM's measures, so we decided to provide these two non-financial measures that our company uses in order to present all aspects of stewardship. That was how we understood faithful presentation. So this is my comment referring to measurement performance measures, and with reference to unusual items. The idea of unusual items seems very clear to us. It seems to us that unusual items, we called it modernized extraordinary items. And we were very happy that the disclosure of these unusual items allowed to present it in all segments of profit and loss statement. That was very important to us, that these unusual items might be allocated among operational, financial, and investment segments. On the other hand, we see a room for presentation of some samples as, for example, whether restructuring or scaling down the business should be unusual item or not. In our case, we think that the proposal misses this information. And the same refers to impairment in a, for example, COVID situation. What I mean is that this is not very obvious from the proposal, how we should treat it, whether it is unusual or not unusual. And this is, from our perspective, it's important from the point of view of in order to compare financial statement between companies. So in our company, we identified 4 types of unusual expenses. We did not find any unusual incomes. Those unusual expenses were one-time compensation paid to the employee based on the agreement signed to earlier retirement. The second one was accruals referring to guarantee passed to the customer. And the third one was court cases brought by the clients. And then there was a group of other insignificant. So the unusual items, although they were understandable and welcome, in our case would constitute a big challenge when comparing local accounting regulation with proposed changes in the IFRS. This is why we encourage to converge Polish local accounting regulations with IFRS. And unfortunately, as far as I know, there are no plans referring to primary financial statement, which is not a very good news for us. That's it from my side.
Eva, let's go to Susanne.
Yes, thank you. So at SAP, it's a little bit similar, like Eva just pointed out. So we have quite many non-GAAP or non-IFRS measures. And with respect to the ESMA guideline and Sarbanes-Oxley Act, we already have a disclosure in our management report with reconciliations. And so for us, the management performance measures is a subset of these measures, but I think Aida also pointed out that it should be a subset. And so we identified in the fieldwork 3 measures as management performance measures, and they are non-IFRS operating profit and non-IFRS profit after tax. And third, it would be non-IFRS operating profit at constant currency. So I come back to that special one later. And in the exposure draft, it is proposed to disclose the income tax effect and the NCI effect for each adjustment applied to calculate the MPMs separately. So, for example, if we have adjustment for share-based payments, we must calculate the income tax effect and the NCI effect for that share-based payments adjustment. And as we are using a bottom-up approach to calculate the adjustments, we have the information of the tax effect and NCI available, but as we build our table for the field work, we found out, or we felt that we then disclosed really a very tiny detail, and we are not sure whether that is helpful to for the users of the financial statement, and because the detail might be not material enough to disclose it. And as I mentioned before, we also have one MPM that is non-IFRS operating profit at constant currencies. And constant currencies means that we are translating our income and expenses of the current year, this prior year's exchange rate. And so for that management performance measure, we approximated the tax effect, but we're not able to calculate the NCI effect. And as constant currency adjustments follow a very different approach than other adjustments that we have, we recommend adding the use of constant currency figures to the exemptions defined in paragraph 104, because we think this is really on a different level than other adjustments, and so we think it should be really included in the exemptions. Thank you.
And then I would like to go to Andre, please.
Okay, thanks, Claes. My comments are mainly on the topic of the unusual items. I think on the MPMs, there's been a lot of very good discussion, but on the unusual items, and I heard it a bit in Ida's description, that users felt that there was not enough common definition, common understanding of what companies were defining as unusual. My concern is that with the current definition, we will still end up with more or less an entity-specific application of this unusual item. So, for example, a global company with operations in many parts of the world might consider that windstorms, hurricanes, and earthquakes are going to happen somewhere in the world every year, and therefore will not be considered an unusual item at the group level, even if at the subsidiary level it would be. So it already engages a reconciliation between the local IFRS accounts, if they prepare them, as many of them do, and the group accounts. And so triggering additional effort between the local accounting team and the group team. And then because of that, they would never survive at the group level to become an unusual item, and therefore would not be presented as such. So, it then means that the definition of unusual items for large, particularly geographically diversified groups might become exceedingly small. Whereas for a small company, the definition of an unusual item be much more broadly applied, and therefore I think the comparability, could be certainly the consistency might be hindered in this. So I think, I'm not sure it goes directly in the direction of having a more common definition of unusual, because the application of it, I think, is going to be very much entity specific, rather than if we identified certain types of events based on some principles that would be unusual. And I think this is where one of the concepts that was in the old IAS 1 paragraph 86, which talked about the concept of predictability and predictive value, I think has been brought over into the standard, but somehow may have gotten a little bit lost. The new paragraph 66, which brings many of the ideas over from paragraph 86, I think has lost this concept of the predictive value. And whilst it may have been brought into other places in trying to introduce that unusual items definition. I think the very narrow application that comes from certain situations will reduce that. I think also the question that was asked about, is it an and definition where it's both the nature and magnitude, I think means that we could say that we always have restructuring in a company, but you can certainly see over the past couple of years that the size of restructuring in Nestlé has gone up dramatically, several hundreds of millions of increase, and then as those restructurings kind of take effect, we might go down again in the future. And then to have that presented, well, first of all, we have the question of, is restructuring a function? I've made my point clear on that one. But, if there are other elements to be considered there, then the unusual nature might, where there's a and definition rather than or definition between nature or magnitude, I think could also be useful to consider. Okay, so thanks, Claes.
Thank you, Andre. With that, we go to the polling questions. And for this section topic, we have 2 polling questions that we can ask the audience.
The first polling question is already open for voting. It's question number 6. And I would kindly ask you to give your vote to the question if the IASB definition of management performance measures, MPMs, is easy to implement and is capturing the right items. So we have 37 votes now. Any more votes? Yes. So, Claes, we have now 45 votes for question number 6. And I would suggest that we go to the second question, to question number 7, where we are asking, is the IASB definition on unusual items easy to implement and capturing the right items? So please give us your votes. So, Claes, we have now 42 votes. So almost the same number like on polling question number 6. So would you like to summarize the results before we go to the Q&A?
Yes, there seems to be a rather strong majority asking for more guidance. So this is split here, but more guidance seems to be the overwhelming position here. With that, I think we should move to the Q&A. We had a number of questions coming up on this topic, so let's go to the Q&A.
Yeah. Yes, we have various questions, and if we would group them by the subject, they're dealing with the question, is the scope of MPMs and unusual items, should they be disclosed all that are in use or only some of them? Could they be combined with other non-financial information? And the question, why are balance sheet items and balance sheet measures or combinations of income statement and balance sheet measures not included in the scope? And with this first set of questions, I would like to hand over to Aida or Nick. Aida?
Thank you, Christoph. So I will start and then maybe invite Nick if he has follow-on comments. So I think a few questions here. One I heard you say is, do we just select some or do we disclose everything? And the idea is that everything that meets definition of unusual income and expense, everything that meets definition of management performance measure should be disclosed. But it's interesting, I think we're finding from our participants today and other participants in field work that the number of these measures they're coming up with and unusual income and expenses is actually not that great. So it's perhaps not a concern that we have heard earlier that there will be maybe excessive number of measures being identified as a result of these proposals. And then the other questions around the measures that do not meet definition of management performance measures. And we heard, Eva, for example, saying she's chosen to include it in the MPM note because they communicate performance in management's view, even though they don't meet definition. And then, other Eva and, Susanne, I think you were commenting that, you clearly understood MPM only capture a subset, so you only disclose the subset. So I think the idea was that what meets definition of MPM is disclosed as an MPM, so you don't label measures that do not meet definition as management performance measures. But then on the other hand, the proposals really don't prohibit in any way disclosure of additional information in the financial statements. And this is an interesting question, I think, to consider as to whether this would lead to this other information being included in financial statements. And then does the IASB need to do anything about it? I think it's something that, will have to be considered as a part of the project, because I hear clearly that people are saying these other measures are relevant and in some companies' cases perhaps more used than subtotals of income and expenses, yet they don't have their place in management performance measure. So I think that's really it. Christoph, was there an aspect of the question I didn't answer?
I think you captured.
Okay.
I think you captured it.
Yeah, Nick, did you have anything to add? Sorry.
It's interesting, the discussion over scope and some calls to widen the scope. I think we're aware this is a contentious issue. It's an issue that people have strong views on, and that's reflected in the polling results. I think we'll have to go back and probably think about scope, but this was, in some respects, a first step into this area for the board. I mean, what I would note is the great deal of enthusiasm we hear from users for this initiative, particularly to have this information all in one place. They find this information is in different places from one entity to another. They describe it as being scattered. And so hence the desire for this to be in a single note to the financial statements. They'd always be able to find this information there.
Yeah, another group of questions is dealing with the subject, whether the unusual items, for example, should be included in the P&L, the face of the income statement, and on the opposite, the discussion why in a single note and not spread over the income across the footnotes, why in one footnote. What's the view of the participants of the panel? For example, Susanne from SAP, what's your view? P&L, one single note, or all over the place? Or perhaps Andre?
Yes, so we've taken the decision to publish a separate document with our alternative performance measures centralized in one document, and then we make cross-references to that for the different uses where it could come into play. So whether it's from the management commentary, management report, or in one of the other documents, the investor presentations, for example. So we understand the usefulness of putting it in one place. I think one of the contradictions that we see is that by having to put some of them into the financial statements and then maybe put all of them into another place, it means that we would have to rethink our approach. Maybe in this case, we would have to put them all into the financial statements, some of them maybe as an annex, which would be out of the scope of the audit, and others which would be in the notes and therefore would be part of the scope of the audit. So I think this is where we feel that there's, some of the clarity that we're looking for might end up being lost. I know that not all preparers do a separate document, and we know that there's conditions to be met. If you put them as a separate document, it has to be freely accessible. It can't require registration, and it has to be available at the same terms as the documents which are referred to. So I think those are some of the concerns. So I understand the benefits that a user might find, but I'm not sure that the application of it, the crossover between APMs and MPMs are going to do that, bring a benefit in that regard.
Thank you.
Okay. We have one further question in the queue. But before, Nick, if I could address a question to you, why shouldn't MPMs and unusual items simply shouldn't be left out of the financial statements? The question from one participant.
So why shouldn't they be left out of the financial statements?
Yeah, leave them out.
Yeah, well, I think we've partly addressed this already. I mean, the very strong feedback, and we did this through our a discussion paper on principles of disclosure, was having more information about key non-GAAP measures that relate to financial information, and to be able to find these easily in a single location, and for that to be in the financial statements, for them to be subject to audit then in all markets. These things are being very strongly welcome by investors. And I think we have to remember the nature of investing has changed over the last 20 to 30 years. Increasingly, people are following wide universes of stocks between different markets and between different sectors. They may not be following the 5 or 6 companies they used to follow. And it's simply that utility. I know if I go to the financial statements, I can find the reconciliation, all of the information that builds on the ESMA requirements for those key management performance measures, rather than spending time trying to find where this information is from one entity to another. And as I say, we have very strong and positive feedback from users in terms of the proposals in this area.
Thank you very much. The last question I would like to address to the preparers who are in touch with the users predominantly. Perhaps Ezio or Eva Maruszewska, what do you think about the question? Don't you think there is a risk of requirements from users for additional information regarding unusual items or items not covered by this definition? So we are giving them one hand with the definition and they are asking for more. What is your view on this? Perhaps,
well, yeah, I think that we may face the risk of requirements for additional information. And I think also that IASB should closely communicate with the regulators that, for example, in some jurisdiction like Italy, already requires for the disclosure of unusual items in order to avoid over-regulation about this topic. So I think that the definition should be clear and should be so closely communicated with other stakeholders of financial reporting, like regulators, that may require for additional disclosures or already required disclosures about unusual items of income and expenses in the profit or loss account.
Thank you very much. Eva Maruszewska, what's your view?
Are you asking about the same question?
Yes, please, yes.
Well, that's quite interesting point of view. I didn't think about it. That's giving one finger, they would ask for more. But yes, it is quite possible, I would say. But on the other hand, what I have in my mind is that we are just at the beginning, and I believe that there would be standards worked out during the couple of years when we start using when the standard goes live. So I think that it might be a situation. But after, as we observe from the previous years in many aspects of IFRS, standards parallel to written standards exist. And I hope that it will be this case also.
Thank you very much. Claes, I think we have one question which is dealing with the subject, why should the operating result without unusual items be shown in the P&L? And the last question, I think, is from Germany. Why couldn't a cross-reference be done from the management report to the APMs? Perhaps this need to be answered by Ida or Nick.
Thank you, Christoph. So again, I will start, and then maybe with the first question you raised around presentation of operating profit without unusual income and expenses on the face, because it's a very common question, and I can see it's been popular today as well. And I think this is consistent with practice in some jurisdictions in particular, where some items are excluded from the operating, such as disposals and the like. I think the IASB's focus with classification and presentation and statement of profit or loss was on completeness and on comparability on the statement. And you would not get this completeness of analysis of expenses if you have this separate category of unusual. That would be not integrated with your expenses by nature or by function. And I think the matter of the fact is nobody is arguing that unusual income and expenses did not arise in the course of the business. They did, and they have been incurred in this reporting period. So the board felt the most appropriate way is to just integrate them with other expenses of the period. But I think the person who asked the question is quite right that this is important to use as analysis, and this is why the information about unusual items in the note has to be attributed to line items in the statement of profit or loss. So by this attribution, investors actually get to know what items relate to, and then they can draw this subtotal if they wish to use information in that way. And then I think
I was going to address the question on cross-referencing, if you like. So this isn't part of the board's proposals as they stand today. So cross-referencing wouldn't be permitted. The requirement would be for the disclosures to be in that single note to financial statements. Clearly, there are examples within our requirements where cross-referencing is permitted, but it's something the board hasn't discussed. I have heard that suggestion made elsewhere, and clearly from a user perspective, if the board was to entertain that, I say we haven't had any discussions, I think they would still seek for those measures to be subject to audit. But yeah, it's part of the feedback that we've heard in terms of could we consider cross-referencing as part of a solution here, but not part of our proposals today.
Thank you very much to all of you. And with this, there being no further questions, I would like to hand back to Claes. It's yours.
Thank you very much. And now we would like to round off this by returning back to the first topic, because we have 2 polling questions that we would like also to, in order to be of completeness, to seek out the views of our participants here today. So if you can please get question 2, polling question 2 on the slide, and then polling question 3 to see if participants still remember the questions and see what the results are. Thank you very much. Yeah, a running comment from my side is that seems that it's a reflection here that seems to be a significant majority here seeking more guidance, for example, the meaning of main business activities. And also there is a rather large group say it's not clear and not easy to implement. So I think there's a strong call here for more guidance, which is also a reflection of what we heard in our discussions today. And also on the question of classifying if they're easy, it's strong view here also for more guidance. So I think there's takeaway from this is that there might be more work that's needed in order to finalize a standard on this topic. Finally, do we have any general questions coming in, Christoph, on the whole webinar today that might want to be raised, or are there any final comments from Nick or Aida and or the panelists that you would like to share before I hand over to Chiara to close out the webinar?
In the Q&A we have a comment on poll question number 5, where an anonymous participant says that poll number 5 indicates almost 50% to have severe problems creating the required disclosures. And the opinion of the participant is that this weighs heavier than the around 36% able to produce this information nowadays already. So this is, so to say, the only comment left in our Q&A queue.
Remind us what that poll was about. Sorry.
The poll was about the systems.
Yeah, by function or by nature system.
By function, by nature. Okay.
Yeah, yeah,
okay. Yeah. And I don't think that necessarily comes as a surprise. That's what we've heard elsewhere from preparers. I mean, I would just like to thank everyone for their participation today in terms of the questions, the polls, what we've heard from the preparers on the panel, both those that participated in the field work and those who've come new to it. As I say, the feedback is very helpful. We think this is a very important project for the board. It seeks to address some long-standing concerns from users. There are some really standout issues that they would like to see addressed in terms of bringing more comparability, better disaggregation, more transparency around non-Gaap measures, those 3 items that I highlighted to begin with. But as ever, we need to understand the practicalities of implementing the proposals to weigh up the costs and the benefits of doing so. And we would encourage, of course, everyone to continue to participate in the process. Just a reminder, as Aida said at the start, the deadline for comment letters is on the end of this month, 30th of September. And we look forward to hearing from as many of you in that medium as possible. But thank you very much for everyone's contribution today.
Thank you, Nick and Aida. I also thank you, a big thank you to the panelists and also EFRAG staff. And with that, I would like to round off this webinar by giving the floor to the EFRAG Tech Chairwoman, Chiara Prete.
Thanks a lot, Claes. So it was very interesting today. I think our panelists have been very generous in providing details of how they found struggling or relatively easy to implement the proposals. In conclusion, I think what we heard today seems to confirm that the IASB proposals go in the right direction. However, like for every big change, there are challenges to implement, and there is a challenge specifically to this project in getting the right trade-off between the comparability and the entity-specific information, so between the more guidance needed and the necessity to leave room for an appropriate judgment to have principle-based standards. We know that preparers usually in standard settings are those that ask for more guidance, more details, more examples. And I think we got some very good examples of what the IASB could further consider in terms of providing guidance. We have discovered that the foreign exchange components is procuring more than one headache to the proposals in trying to implement, and may result also in some additional IT costs. Then we got interesting suggestions on how to enhance the practicability and definitions of the new approach, such as, for example, definition of strategic investments to get more principle-based, the integral, non-integral classification. We also got some insight on how the implementation might differ from small entities that have to cope with the very local regulation and reconciliation with local GAAP versus big entities which are diversified geographically, for which what is valid at the local level for a subsidiary level is not necessarily easy to reconcile with the view at group level. We have also learned that there is more thoughts to give to the interaction between the different standards, how a standard would interact with IFRS 5, with IAS 28. We have also learned that it's good to have a look to how the definitions would be resisting to the different phases of a cycle of investment and divestment, for example, and this relates to both the investment category and also the subsidiaries and joint venture integral, which are part of the operating. I was glad to see that 73% of the participants of the polling questions are preparers, so our staff may benefit a lot from the results of the information that we've got from the participants. You were before noting that 50% needs to engage into IT transformation for the by nature by function. I think this is a very important point to note. In conclusion, I would say that this exchange of view today confirms how important it is to engage with preparers, to have their availability to test in practice the proposal also for future projects. It's a relevant component of our standard setting. So in my opinion, we definitely met the purpose of this exercise and this event. We brought value to EFRAG, and if I may speak for the IASB, also to the IASB due process. So I would leave you with a big thank to all the participants, to the pool, to the preparers that accepted to engage with us with this level of detail. We appreciate a lot of their time and effort. We thank Business Europe for organizing with us this event. And of course, we thank the IASB for the cooperation all along this joint field test exercise.
Thank you for that, Chiara. With that, I would like to close the webinar for today and say thank you to all of you again, and see you soon. Take care.
Bye.
Thank you.
Bye-bye.
Bye-bye.
Thank you.
Thank you. Bye.
Bye.